Edge designations, CFA Level 1, pre-reading economics. This is the final learning module of the 7. Learning module 7, currency exchange rates. As per usual, we reproduce the learning outcome statements on the front page. And here they are, learning outcomes for learning module 7. Only 4 learning outcome statements, but fairly lengthy each one. And generally, candidates find currencies, foreign exchange to be a little bit challenging, so we're going to take you through that. And as we get to some more complicated stuff, we'll go through that a little bit more slowly and a bit more carefully. But yes, you can expect a few more calculations here in currency exchange rates as we go through things like cross-currency rates, forward rates, things like that. Okay, let's get ourselves going straight away. Top of page 2, and as per usual, we reproduce the learning outcome statement over there, each one relating to its section. We start off, define an exchange rate, distinguish between nominal and real rates, and then again distinguish between spot rates and forward rates. Okay, we're going to try and cut out as much of the technical stuff as we can, try and make it as simple to see as possible. There's a lot of technicals that try and confuse things a little bit. We'll try and make that as simple as possible as we go. No need for complications. Okay, we get going over here. What is an exchange rate? I'm sure everyone's familiar with that. And all that, and look at the words. I think that's the key. We know what it is, but let's just focus on the words for a second. And it's an exchange rate. It's the price of one currency that we exchange in terms of another. Okay, and the exchange rate is the number of units of one currency that one unit of another currency will buy. Okay, and where some complications sometimes kick in, we talk about the exchange rate that one currency will buy, okay, between price and base currencies. And it's always important to remember, and I'll just give you a quick example. Okay, let's have a look over here. So let's say you've got a US citizen. Now remember, US citizen is holding US dollars. Okay, and let's say, for example, he now wants to buy British pounds. Okay, just in terms of the transaction itself, okay, when he buys British pounds, being a US citizen, what is he going to use to pay? He's going to pay US dollars. Okay, so that would be the first leg, perhaps, of the transaction. A US citizen wishing to buy British pounds, he will pay his pound. He'll pay US dollars. In turn, he will receive pounds. Let's say, for example, he has no longer any need more for those British pounds. What will happen is he will then look at the transaction, sell British pounds, and then receive US dollars in return. Okay, so it's often we've just got to try and get the picture right, but once that clears up, obviously things will become a whole lot easier. Okay, we now look at the different ways. Exchange rates are what we call nominal exchange rates. When we exchange base currencies and price currencies, that is called the nominal exchange rates. Okay, now if we try and exchange that, differentiate between that and real exchange rates, okay, real exchange rates, we talk about indices that are constructed by economists and other market analysts. Okay, now why is it called real? Because we always know the word real. When we talk about real, the first thing that should come to mind is inflation, okay, purchasing power, okay. And the minute we see now real exchange rates, we talk about what analysts use to assess changes in the relative purchasing power of one currency compared to another. So now we're saying, well, hold on a second, it's not just what we'll exchange one currency for another, but now purchasing power. And remember, whenever you see the word purchasing power, inflation should kick in there as well. Okay, so let's give it a formal definition. The real exchange rate is the nominal rate that's multiplied then by the ratio of price levels, because remember the difference in price levels between two different countries, and we'll talk about how we measure price levels. Okay, that indicates the purchasing power of each currency. Okay, now if you've got an increase in the real exchange rate between two different currencies, that would imply a reduction in the purchasing power of the domestic currency. Okay, and I'm just going to show you this very briefly because we're going to see a lot of notations as we go through. RD over an F. What's RD? Now just look at the words, and you're going to see these as we go through. I'm going to write it a little bit bigger. We've got RD. That's D is the domestic currency, R is its real rate, and F is the foreign currency. Okay. We talk about what are spot exchange rates. What's a spot exchange rate? That's not for settlement much later on, because that would be a forward rate. A spot exchange rate is settlement for today. Often they say T plus 2. Okay, it'll depend, of course, on the market. T plus 2 is not now, but for 2 days' time. And you've got your forward exchange rates, which are rates that are agreed upon for a forward date. And again, it'll be depending on what that forward rate is. Okay. I'm not going to spend too much more time over there. We will look at those as we go through the particular set of notes. Okay, we talk about the different functions and participants in the market. We've got the market functions. The function of a foreign exchange market is to facilitate international trade among different players from different countries for the transfer of goods and services. Okay, another large proportion of the daily turnover in the forex markets is for capital market transactions. What are capital market transactions? Investors convert between currencies as they move their money in between different currencies for the purchase and or sale of foreign assets. Okay, and I'm not going to spend too much. As I said, guys, it does get quite technical. We put everything down here for you, so if you want a bit of a deeper look, but just in general, okay, spot transactions, okay, involve the exchange of currencies for immediate delivery. We spoke sometimes it's T plus 2, T plus 1. It'll depend on the particular currency and the country, whether or not it trades immediately, 1 day later, or perhaps even 2 days later. Okay, we call that rate, if you look in the what we call the spot market, that's called the spot exchange rate. Okay. However, that only makes up a small component of the total market. There are other large components of the forex market, okay, things like forward contracts, foreign exchange swaps, and foreign exchange options. And that's obviously, as you move further then into the derivative forex market, obviously that becomes a much larger market. A forward contract, and again, guys, when you start to study one of the key points we always mention is just look at the word. Sometimes people try to say, what's a forward contract? What's a forward contract? And trying to memorize things. That's not a great strategy, because often what we find is due to exam stress and just general forgetfulness over time, easy to forget that kind of stuff. But if you understand what it is, it's a contract forward. In other words, we're going to put a contract into place now, and we are going to agree on the foreign exchange rates for when? A forward date. But we agree on it now. When does the actual transfer of the currency stroke goods take place? At some kind of forward date. Okay. Let's have a look at a bit of an example over here. Okay. A US-based company is expecting to receive 50 million euros in 90 days' time. Okay, so we know when they receive those euros, and again, let's just look at the transaction again. So they are going to receive euros, okay, 50 million euros in 90 days' time. But remember, when a US company receives, okay, or a US investor receives euros, they don't want euros. What do they want? Well, their home currency is dollars. So when they receive the euros, just to follow the transactions, number one is they're going to sell them. Okay, they've got euros in their hands. They don't want euros. They're going to sell euros, and essentially they're going to be buying dollars. Okay, that's just a way of looking at it. Okay, let's have a look over here. Okay, although it could convert these euros to US dollars at the date, in other words, at day 90 when they receive them, okay, what are they worried about? They're worried about that in between now until that particular point in time, the rates may move against them, okay, because we don't know what the rate will be in 90 days' time. What they could do, they could avoid this particular risk, and they could enter into what we call a forward exchange transaction, and they could sell and again, it's important as we go through the notes just to understand what they're doing, because you're entering into a contract for what? To sell euros, and obviously you'll be buying dollars, okay? That's the transaction. Why are you selling euros? Because remember, again, you are going to receive euros as part of maybe a dividend or something like that. You don't want euros because you are a US citizen, you want US dollars, so you want to get rid of them. How do you get rid of them? You sell euros, but remember, always the other side of the transaction then is going to be, what are you going to buy with it? Because you're buying and selling, and of course you will be buying dollars and selling euros. And a forward contract, okay, will allow you to fix the rate today, okay, for the transaction that will only be occurring then in 3 months' time. So your price risk is now gone away. Your foreign exchange risk of that rates may move against you is no longer there because you have fixed that particular rate. Okay, I'm not going to spend too much more time over there, and we'll see some of those calculations in greater detail as we move through the notes. Okay, and let's have a look at another type of a transaction. Now we're going to talk about a foreign exchange swap. Is everyone comfortable with this so far? We've really dealt with two types of transactions thus far. We've dealt with a spot transaction. The spot transaction happens at that particular exact point in time. Yes, sometimes a day later, T1 or maybe perhaps T2. We've looked at a forward contract. Okay, the forward contract is we know we're going to be receiving money, let's say in 3 months' time, foreign currency, and you can fix the rate today for what you will be receiving then in 3 months' time. Takes out a specific part of the risk. Let's talk about a forex swap. Okay, let's just say, for example, today is the 20th of November, and it's T+2. We're going to do spot settlement 2 days later. Okay, a 3-month forward settlement then is 22nd of November. There's your 3 months forward. Okay, and again, the various terms will differ. Are we talking about business days? Are we talking about actual days? Okay, just keep that in mind. Okay, traders will always confirm the exact forward settlement date when they make the trades. Everything is nicely documented, and there's very little that's left to chance. Okay, now we move to the OTC market. OTC, over the counter, remembering again from the derivative section, over the counter is really over the counter. In other words, it's just between two parties. Okay, and then the size of the forward contract can be any size. Okay, just a size that both counterparties agree upon. Okay, the OTC market accounts for a large portion of foreign exchange trades. Okay, and keep in mind as well, there's a very liquid market in exchange traded futures. Now remember, when we move away from OTC is over the counter between two parties. That's not very liquid at all. But when you move to an exchange traded, in other words, it's traded on an exchange, yes, of course, the liquidity improves drastically. Okay, and let's have a look at our next item. Okay, forward exchange contracts generally would expire, okay, and over a 3-month period or something like that. But remember, you might need protection, or what we call a hedge, against your currency position for a longer term period. Now, what would you do if you could only get your hand, let's say, for example, you wanted protection or a hedge against the foreign currency for a year, 1 year, but you can only get your hands onto a forward contract, okay, either be it OTC or exchange traded for a period of, say, 90 days. Well, what would you do? Well, you could enter into that 90-day contract and then do what? Roll it over for another 90 days, in other words, get another one, and roll it over again, and okay, so there are ways of doing that. Okay, And look, that's what we're saying over here. Because forward contracts eventually expire, okay, if you have a speculative position, okay, or whatever you need for any type of foreign exchange hedge that you enter into, some type of a forward contract needs to be extended. So your forward contract now needs to be extended. Okay, what do you need to do? You need to keep rolling it over. Okay, and which involves getting rid of it today after the first 90-day period, okay, and entering into a new one for a new distance settlement date. So just very briefly, okay, so let's just say, for example, here are your periods, and look what would happen. Just say, for example, you needed 12-month protection or a hedge or anything, whatever we spoke about that, okay, and let's say, for example, you entered into your various into a forward contract. Now that forward contract, okay, expires after 3 months. So what would you do? So you buy a 3-month contract here, enter into it over there, time period 0. It goes 3 months and then it expires. Okay, then what do you have to do? Enter into another one for time period 6. That one will then expire. Enter into another one for time period 9, and it'll expire time period 12, when in fact is when you really need it for. Okay, and this combination of entering into a contract, coming in, coming out, okay, is what we're going to refer to now as our next case of the foreign exchange swap. And let's have a look at this particular example. Okay, a trader sells 10 million euros. Okay, but remember he's selling something. Okay, he's selling the euros, the settlement for 90 days. But what is he? What's the currency that he's using? And we can see over here, US dollars. Okay, so in 88 days time, okay, we're talking about T plus 2. Okay, we're going to roll the contract forward. Okay, and we'll talk about the foreign exchange swap. Let's go and have a look. First and foremost, the trader will buy 10 million euro spot. Okay, T plus 2 is going to fall out on day 90. Okay, the same day as the settlement of the forward. Now, what did he enter into? Just let's try and understand the transaction. What did he enter into? He entered into a forward contract to do what? To sell 10 million euros. Okay. Now, if he's going to sell 10 million euros in 90 days' time per his forward contract, well, you better have it. And that's why on day 0, that's what we call it first over here, he buys 10 million euros spot, okay, so that when the settlement date happens 88 days later on day 90, well, he's purchased the 10 million euro spot, and that's what he's going to use to satisfy the 10 million euros that he sold per the forward contract. Okay, but it's important to remember, because the 10 million euros are being bought and sold on day 90, on that particular day there's no real exchange of euros. Why? Because the two counterparties are both dealing in euro, so there will be a net impact of 0. Okay, but remember, on that day there will be an exchange of US dollars, okay, and that'll reflect how much the US dollar and the euro have moved in apart, okay, over the time period. Okay, let's carry on. Suppose that on day 88, the spot rate for the US dollars, remember we started off, what was it? It was 125 when we started off. If memory serves, let's go and check that. My apologies. Let's just see. So per the contract, it is 125. Okay. Now let's just say, for example, the rate at the end is in fact 124. So it's one cent difference. Okay. Let's have a look. The trader is going to see cash flow then of 100,000 US dollars. And how do we get that? Well, it's 10 million euros. And remember, the difference then between the contract price per the forward contract, okay, versus the actual spot rate at the time. Remember, the forward contract is the rate that they've agreed to between them. That can't change. Okay, the difference will then just result from the spot contract. Everybody comfortable with that? Okay, let's go for point number 2. The swap is then used to initiate a new forward sale of 10 million euro. Why am I doing this a second time? Because remember, I didn't only want protection for 90 days, I wanted it for a longer time period. So now, second, I just do this again, don't I? And I renew my forward position for another 90 days or for whatever the new date happens to be. Okay, is everyone comfortable with that? So remember, because often, and the reason that we do this, we keep swapping over, okay, is because often what we find is that a particular contract may not be sufficient for the protection or the hedge that we need. We need a longer term period. Perhaps we can't find such a contract in the market, so we buy what we can and we swap forward all the time. And just to understand the process, a forex swap consists of a simultaneous spot transaction, in other words, at the date that it expires, and then you enter into another forward transaction. Okay, these swap transactions can extend, or what we call roll the position to a new date, to a longer date. Okay, rolling the position leads to a cash flow then on settlement date. Remember, we saw that where the US investor there gained himself $100,000. Okay, there we go. I'm not going to spend too much more time over there. Okay, and just in terms of what we need to take out from this particular reading, a forex swap consists of, at exactly the same time, a spot transaction, okay, as well as a brand new forward transaction. These swap transactions extend or roll the position to a new date, okay, and we spoke a bit earlier, they at the particular date that they expire, the first one, okay, there is a what we call a cash settlement on that particular date. Okay, and I'm not going to spend too much more time then on that. Okay, just to move down to page number 6 over here, we have a quick look at the market participants. Who are the people that are involved in the particular foreign exchange market? Remember, of course, you've got, as we mentioned a bit earlier, there are buyers of foreign exchange and there are sellers. So we're going to look on the buy side and on the sell side. The buy side, okay, we can break those down into several categories. Okay, you've got corporate accounts, in other words, corporations that deal with cross-border purchases and sales of goods. You've got your money accounts, your real money accounts, okay, and this just talks more about using foreign exchange for investment purposes. Leveraged accounts, that's obviously when we start to make use of foreign exchange, but do so in a leveraged or a borrowed manner. Things like CTAs, commodity trading advisors, which you see often with hedge funds, algorithmic traders, etc., etc. Okay, you've got retail accounts. Those are for generally people more on the retail market. We talk about here, okay, foreign tourists exchanging currency. It's a little bit old-fashioned, of course. Okay, governments as well may enter into the foreign exchange markets to buy currency. Central banks as well, okay, in order to try and influence the level of the exchange rate. They may get involved in the market as well. Okay, and there we go. Now we have a look. Okay, just a note while we are here. The amount of foreign exchange reserves being held by emerging economies, okay, comfortably exceeds those held by developed economies. So again, just talking about just how much central banks hold of their currencies, of other currencies, reserve currencies. That's what that is referring to. Okay, the sell side generally consists of who's selling you the currency. If you need currency, just let's talk very easily in terms of, let's say, a retail investor. He wants to go overseas. Where does he get money from? Okay, foreign exchange dealing banks. Okay, we look over here. A large and growing proportion of daily forex turnover, okay, is accounted for by the massive dealing banks, Deutsche Bank, Citigroup, UBS, and of course this will change as the market changes. And you've got a whole bunch of other banks that fall into like what we call second and third tier on the foreign exchange market, sell side, that also sell and deal in currencies, but perhaps are a bit smaller. And again, I'm not going to go too much into this because this will obviously change as the market changes. Okay, the size of the market is massive. Okay, and just looking, perhaps a little bit old, from the 2010 Bank for International Settlements data. Okay, and again, as I said, it's perhaps a bit old, April 2010. Okay, the average daily turnover in the traditional forex market was 3.9 trillion US dollars. So you can see it's just absolutely massive, the amount of monies that transfer. And we know the reason for that, of course, because of the global economy. All countries are trading with one another in a global marketplace. And of course, there's a need then for currencies, and obviously we can see then how that gets impacted just by the absolute massive size then of the forex market. Okay. We get ourselves going a little bit further, okay, and now we move to the next learning outcome statement. Okay, we get to a little bit of maths. We're going to see that soon. Calculate and interpret the percentage change in a currency relative to another currency. Is your currency strengthening? Is your currency weakening? But remember, what's important, obviously, in all of these different calculations, it's a relative concept, isn't it? Because your currency, you can't say, let's say, for example, the US dollar strengthened. Okay, strengthened relative to which currency? Okay, it might have been a broad-based strengthening, in other words, against all the currencies. But again, okay, one has to see that. Okay, let's have a quick. Let's take another quick peek into the market. Okay, most times currencies are denoted by their standardized 3-letter codes: USD for dollars, EUR for euro, JPY for yen, GBP for pound, and ZAR there for the rand. Okay, and let's just say, by way of example, one can hold an individual currency. Let's say, for example, a 10 million rand deposit. Okay, an exchange rate is then the rate which we would exchange between currencies, for example, between ZAR and GBP. Okay, what's also important, okay, is the rate, is the number of units. That's all. It's an exchange rate. It's the number of units of one currency, which we're going to call the price currency, okay, that one unit of another currency, the base currency, will buy. Okay, we'll talk about that as we go. And let's move on to exchange rates over here. Top of page 9, we give you a whole batch of different what we call foreign exchange quote conventions. Okay, and often I wouldn't spend too much time, just have a look at this, guys, but just if you look over here, the euro, the name convention is when you trade euro. Okay, it's your price currency over your base currency, how many euros you are required in order to buy a dollar, and there's all your various exchange rates. Okay, everybody come, let's have a quick look over here. One can refer to the euro as a currency, but if we're referring to the euro exchange rate, it's the price of the euro in terms of another currency. In my example over here, the US dollar. Okay, we'll talk about cross rates as well when we move in between different currencies. That's something that we're going to speak about as we go forward. Okay, when both currencies are mentioned in the code, the base currency is what's mentioned first. Okay, and interesting enough, that's the opposite order, and this is where it gets a little bit complicated. One really just needs to keep your head about you, okay, of the actual ratio, which is P to B. It's often how we remember it, price to base. Okay, regardless of where a market participant is located, there's always a mix of direct and indirect quotes. Which way are you quoting? Are you going price to base or base to price? And that's where the complications often come in, because you've got to know exactly what you are dealing with. Okay, and often that'll change depending on how the quote is. Is the quote quoted directly or is it quoted indirectly? We'll have a look at that. Okay, let's have a look at some exchange rates. Let's say if I said to you the South African rand is trading at 0.10 to the US dollar, okay, that means that 1 South African rand will buy you 10 American cents. Okay, everybody comfortable with that? Okay, just keep in mind, of course, okay, the currency in which the quote is made generally goes in the numerator, okay, and the denominator is the currency that you are interested in our particular case, what we would say, and that's because we're working in the South African rands. That's US dollars over ZAR is equal to 0.10. In other words, 1 ZAR, okay, will purchase you 10 US dollars. In this particular case, guys, the ZAR is the base currency. The currency that I'm using to purchase, I'm using ZAR, 1 ZAR, okay, to purchase the price currency, US dollars. How much do I get? Well, I only get 10 cents. Okay. A decrease in this exchange rate, okay, would mean that the rand costs less, or that less US dollars are needed, okay, to buy 1 rand. Okay, in other words, the US dollar is appreciating, and you can always look at it from both points of view. Either the US dollar is appreciating, but remembering again, guys, it is a relative concept. So if one currency is appreciating, well, then of course the other one is depreciating. Okay, let's talk about the inverse rule. The inverse rule is you can just reverse that quote. Okay, and 1 US dollar, if I now just reverse that, okay, would be equal to 10 ZAR or 10 rands. Okay, and I think we've seen quite a bit of this already. Okay, I'm not going to spend too much more time over there. Okay, let's just have a look over here. Okay, let's have a look at a question. Okay, it's too nice to pass up. The exchange rate is US dollars rand 0.10. In other words, if you spent 10 US cents, you'd get a rand. Okay. Now let's say, for example, you wish to purchase South African diamond, and he says to you, the South African diamond dealer says that the quote is 30,000 ZAR per carat. Well, how many dollars will 5 carats cost? Okay, so first and foremost, just to note, the diamonds are quoted in rands per carat. In other words, the numerator, okay, is rands. The denominator then is carats. We know all of this already. Okay, how is the exchange rate then quoted? It's given in dollars to rand. In other words, dollars are numerator, rands are the denominator. Okay, and look what the question asked me. The question said to you, how many dollars do you need? Okay, so look what we do. Okay, 30,000 rands, okay, over carats, times, and we know it's 0.10, not know what's 0.10, 10 US cents per 1 rand. Let's multiply all of those out. Okay, 30,000 rand times the 0.10. How many carats do I need in the rands? Okay, we notice that the rands cancel out, and we are left with $3,000 per carat. Remember, of course, we wanted 5 carats. Okay, and that'll be $15,000. Okay, everybody comfortable? I'm not going to spend too much more time over there. Okay. We talk a little bit about it, but it's not really the specific purpose of these particular sets of notes. Okay, we talk about PPP. Okay, PPP is purchasing power parity. And again, guys, look at the words PPP, purchasing power. Purchasing power generally refers to some kind of inflationary concept. Okay, and it describes the long-term equilibrium of nominal rates. Why nominal rates, not real rates? Because nominal rates would include inflation in there. Okay, and what does PPP as a theory tell us? That nominal exchange rates adjust as we move around, so that the same basket of goods, of identical goods, will have the same price in different markets. In other words, what's the difference then between a McDonald's burger in the US and a McDonald's burger in South Africa? Just the exchange rate, because it's an identical good, isn't it? So came along the specific index. It was used to be called the Big Mac index. Okay, I'm not sure if it's used that much anymore. How we see it over here. And what that said is, well, if you can find yourself a Big Mac in the US and a Big Mac in South Africa, well, the difference will only be the exchange rate. Then they said, well, hold on a second. The actual exchange rate between the US and South Africa is not exactly the same as indicated by what we call the Big Mac index. Of course, there's reasons for that, but they gave a bit of a sense of where the exchange rates could in fact go. Okay. We know, why doesn't the PPP hold? In other words, why can't you always forecast the exact exchange rate using the PPP? Why? Goods and services are not identical across countries. Okay, there's different baskets of goods, of services, okay, produced and consumed. Often goods and services are not traded internationally. Okay, trade barriers and transaction costs, import taxes, things like that may impact as well. And cash flows are at least as important as trade flows when you determine nominal exchange rates. Okay, so yes, PPP is a lovely concept, purchasing power parity, but we see there are various reasons why purchasing power parity as a theory may not hold exactly when we are trying to calculate exchange rates. Okay, I think we've seen most of everything over there. I'm not going to spend too much more time. Okay, let's move on to the top of page 12. The foreign price level in a domestic currency, and we've seen this also before. It's the spot rate of the foreign over the domestic, and that's the exchange rate. Okay, there we go. Nice and simple. Okay, and I say, guys, don't be overly awed when you see these notations. It starts to get a little bit complicated, perhaps. Just look what it's telling you. S is the spot, F over D, okay, D being domestic, F being foreign, times PF. That's the foreign price level quoted in the foreign currency. So I've got my foreign price. I just don't know how much it's going to cost me. Let's just talk about the foreign price being, I've got a US price. I know the good in America is going to cost me $100. I just don't know how much it'll cost me if I'm paying in South African rands. And that's the first part over here. I said, well, then just apply your exchange rate, which is F, the foreign rate over the domestic rate, times by the price of the good in the US. Well, then I'll get to exactly how much that is. Okay, the real exchange rate. Okay, and look what we're doing over here. Seems very fancy, but it's not overly fancy, because it's really just S, okay, FD. Now remember, guys, I want to try to make this easy as possible. Let's just get rid of that. Now with this one we've seen already. SFD is SFD. That's just the spot rate in the market. But now I want what, guys? I want the real exchange rate between the currencies. Real means I need to take into account inflation. What's inflation? Pricing. So I just take my actual exchange rate, my actual rate over there between the currencies, spot of F over D, and I multiply that then by PF, PD. P is what? Those are price levels, aren't they? Price levels, inflation, and then we get to real exchange rate. Everybody comfortable with that? Okay, remember, here's the crux. We finally got to the, well, not the only crux, but an important component. We've got what we call a two-sided price. What's a two-sided price? A two-sided price is, remember, every time, okay, there's always it's one rate, one currency, in exchange for another. Okay, okay. The bank will provide what we call the bid. Now remember, the bid is because you come into the you come into the bank and you want to exchange foreign currency with the bank. So the bank will give you two prices. This is called a two-sided price. Okay. So we've got, don't confuse. We've got the two concepts. We've got a two-sided price, and two currencies. Okay, so that's what it often makes it a little bit complicated just to keep everything about you. But the two-sided price is a bid and an offer price. Now, why is there two different prices? Okay, that's obviously the big question. I mean, why is there not just one price? Okay, well, there's two different prices. When you come and buy from the bank will give you what price? If you are a buyer, the bank will give you the offer price, the higher price. That's what the bank is going to sell it to you at. Why? They want to make some money. When you come back from your holiday and you no longer need your currency, what do you need to do? Well, the bank's going to buy it back from you. At what price? A lower price. Okay, so remember, you as a the bank as the dealer is always going to get the better price. They're the dealer. So when you come to them, they're going to say, oh, we're going to give you the sell price, the offer price. When you come to them when you've had enough and you're selling back to them and they are now the buyer, always look at it from 2 points of view. This is the dealer, the bank. The bank now is going to buy it back from you because who are you now? You, the retail guy or the seller. Okay, and what happens? They're going to buy it back at the lower price. Of course, that's the two-sided price. And there's always a bit of a difference then between the ask and the bid, the buying price and the offer price. Okay, and that's just called your percentage spread. Okay, suppose that the pound sterling is quoted at 144.20. First of all, what do you notice? Generally speaking, in the forex market, we go 4 decimal places. I know everybody always asks that as candidates. How many decimal places must we show? Generally, you show 4 decimal places. Okay, and it goes from 144.20 to 32. What does that mean? This we could show it like at 144.32. Can you see there's a bit of a spread between the 20 then and the 32? Okay, and then what is my percentage spread? It's the ask price of 144.32 less the bid price of 144.20 over the ask price of 144.32. Don't forget to times it by 100 to get to your percentage, and you get 0.083%. Okay. Generally, heavily traded currencies have wider traded currency or heavily traded currencies. The spread is very narrow because there's a lot of liquidity in that particular market. Less traded currencies generally have got what we call higher spreads. The higher spread, of course, reflects the lower levels of liquidity. Okay, we're not going to spend too much more time. There's a lot of stuff over there, and there we go. Okay, and we give you a little bit of an example over there to take a look at the various currency quotes, how they are quoted. Okay, changes in exchange rates. Okay, generally speaking, when exchange rates are free to fluctuate, there are no currency controls in place. The value of a currency will appreciate, and on the other side will depreciate as it responds to changing market conditions. Okay, any change that changes the quantity of goods and services bought by foreigners relative to what is sold to foreigners, and as you can see, guys, then it's a little bit of supply and demand at play over here. Okay, on page 14, the exchange rate value of a currency will change when people's incomes change, when there are changes in inflation rates, and when there are changes then in interest rates. Okay, and let's have a brief discussion around these particular points. Changes in income. If people's income increases, they spend that additional income on, yes, perhaps domestic products as well, but they can also start to increase their spending then on imports. Now, if they're spending on imports, let's talk about a South African. Okay, a South African guy. Now he's got a little bit more income. Okay, and he wants to buy US dollar products. He needs dollars now. Okay, so what does he do? And just focus on the transaction. He needs, okay, US dollars. So what does he do? He's got to buy US dollars. If he wants to buy US dollar products, he's got to buy US dollars so that he can pay for the US dollar products. He buys US dollars. Now remember, what's the other side of the transaction? He sells rands. If he sells rands, now remember, just generally speaking, the more you buy US dollars, what are you going to do to the US dollar currency? Okay, you are going to improve their currency, and if you sell rands, well, that's the other side. If you keep selling down a currency, let's talk respectfully, because you don't want it, perhaps, okay, well, that's going to drive that currency downwards. Okay, and as per normal, imagine we would have one economics lecture without a graph. Supply, demand, movements of curves could not be. So here's our graph, of course. That's the dollar price, and there's the quantity of foreign exchange then in rands. Okay, now let's have a look over here. An increase in imports will increase the demand for foreign exchange. So yes, you want to buy more US dollar products, well, you've got to buy dollars, and that will drive the demand for foreign exchange. Okay, that as the demand for dollars increases, the rand price of the dollar goes from 8.50 to 9. Why? Of course it does, because you've got a demand for US dollars. Okay, there's the quantity required of US dollars. What does that do? Pushes the price up from 8.50 to 9. Okay, in other words, and what's happening? Look at the words. You'd say that the US dollar is strengthening versus the rand weakening. Why do we say that? Just the logic behind that then, guys, is because what's happened is that there is less demand for rand but more demand for dollars. We're buying dollars. As you buy dollars, it pushes the rates that way. Okay, we've got a little example over here, changes in real exchange rates. Okay, a British consumer wanting to buy goods made in the US, okay, will be what we call an increasing function of the nominal rate. And we've seen this before, guys, haven't we? And guys, when you start to see these things, so you've seen this already. What is this? What is the real exchange rate, guys? It is the spot rate of pounds to US dollars. But remember, I want the real rate. Real rate takes into account prices. Now, prices then is CPI over US dollar GBP. Now, if I take you back a page, you'll say, but is that the same? Well, yes, it is, because remember, let's go back. We're going to have to go back a few pages. Oh, here we go. Again, the real exchange rate over here, what did that take into account? So, yes, you could say CPI, price index, or you could just use prices over there. It's exactly the same thing. Real exchange rate must take into account some kind of price movement, stroke inflation, stroke CPI. You could call it what you wish. And that's that same formula then on there on the bottom. Okay. I'm not going to spend too much more time over there. It looks like this very, very fancy formula, but it's not really. Okay. It's not really. Okay. And we talk about the change in the real exchange rate. Okay. And remember, it's just going to be, okay, the difference then in the spot rates and in the price movements. When I'm working with indices, sometimes what we do is we add 1 to get to get that index to where it needs to be. And you can see we're adding 1 over there. But always remember, and I hope you guys remember this very well then from the quant section, the minute I'm dealing then with, when I add 1 to something, don't forget to minus it then on the back end. And that's all that I'm doing over here. But again, guys, it's just so important to remind you that all that we're doing over here is we are getting the spot rate over the price movements. Yes, I'm adding 1, but I'm subtracting 1 then on the back end as well. Okay, and do take a look at that example. Whenever I put an example in the notes, I always ask the candidates, please, we discuss it in the videos. Okay, sometimes we do them with you directly, but when you go over it again, which I'm hoping everybody does and doesn't just watch the video once and say, yeah, that looks intuitively correct. Oh, I like that calculation. I understand it. Let me move on. Please don't just do that. Go back and do the calculations again yourself, because often you find, oh, sorry, you get the wrong answer. You don't get the difference in of 13%, and you think, well, why not? Oh, sorry, you forgot to minus 1. Oops, you forgot to add 1. But when you do the calculations again yourself, you will pick up those amounts, please. Okay, and I'm not going to spend too much more time over here. Just to discuss this note very briefly. Okay, when considering the real exchange rate, okay, as we stated, with the domestic currency as the price currency, what are we doing? We're representing the real price that you need to face or to pay in order to purchase foreign goods. The higher the price, the lower your purchasing power relative to that of the other currency. And we can see this with the developing or emerging markets, okay, as they try and compete then on the developed market stage. We often find that our purchasing power, or the purchasing power of the developing countries, is a little bit lower relative to the developed countries. Okay, and there's another example. I'm not doing that with you guys, of course. Do take a look at that. It's an important one. Okay, but again, let's just see where we are. Okay, if I just take you back. Okay, so is everybody comfortable? We've dealt with changes in income. Let's have a brief look. We're going to still look at changes in inflation and then changes in interest rates. So changes in income is a big one, how that impacts foreign exchange rates. Let's now go and have a look at changes then in inflation. Oops, I've turned too many pages. There we go. Okay, changes in rates of inflation. Domestic inflation, okay, as your prices domestically starts to rise, that'll cause your currency to depreciate, okay, and of course, in the foreign exchange market. Let's just say, for example, if prices in South Africa rise by 40%, okay, and everybody else has got stable prices in the world, okay, this domestic inflation then of 40%, okay, will cause South African consumers to increase their demand for imported goods, because you say, well, why would I pay 40% more for goods in South Africa when I can buy them overseas at the same price as they were last year? Okay, so no one wants to buy South African goods, they're too expensive, okay, which will result in a reduction of the supply of the foreign currency, okay, and we find the rand is depreciating as shown in the picture over here, then relative to foreign goods, because the quantity of foreign goods, as we mentioned, everybody wants to rather buy in rands, okay, and pay 40% more when you can buy overseas. What about changes in interest rates? Okay, of course we know that investments are sensitive to changes in rates, and as interest rates, for example, will rise in the market, okay, as interest rates rise in the market, what would you do? Well, I'm going to go put my money there. Why? Because I'll get a much better rate if I put my money there at the place where interest rates are higher. Therefore, increases in real rates, okay, will cause that particular country's currency to appreciate, because everybody's bringing their money there. There's a demand then for that currency. And just very briefly, guys, remember we spoke about, okay, income, inflation, and rates, okay, and let's have a quick look. What would cause appreciation? Slow growth of income relative to your trading partners. A rate of inflation that is lower than your trading partners will cause your currency to appreciate. And if your domestic rates are higher, guys, learn these interactions. Again, your currency will appreciate. Okay, what will cause your particular currency to depreciate? Okay, rapid income growth. Okay, and you're starting to spend more money overseas. A rate of inflation that's higher, and domestic interest rates that are lower. Okay, we move on. Explain the effects of exchange rates on countries' international trade and capital flows. A trade surplus, let's talk about the surplus first, is obviously matched with a corresponding deficit in the capital account. We spoke about this when we spoke about the balance of payments, particularly surrounding the current account and the capital accounts. Okay, remember, it's called the balance of payments for a reason. The payments need to balance. So if you've got a surplus on the one, on the current account, you'll have a deficit on the other. Okay, and of course, that now has got a strong impact then onto the foreign exchange markets. Okay, the impact of exchange rates and other factors on trade balance, okay, is mirrored by their impact on capital flows. They each have an impact one on the other. Okay, and we remember this equation well, hopefully, okay, from the previous learning modules. Okay, and this is the relationship between the trade balance and expenditure or saving decisions. How do we see this? X minus M, in other words, exports less imports, is equal to what? S minus R, savings less what's invested. Don't forget to add in T minus G. T is taxes, and G is the government expenditure. Okay. What do we see? A trade surplus. What's a trade surplus? A trade surplus is when my exports, I'm sending out of the country more than I'm bringing in via imports, is reflected what we call a fiscal surplus. Okay. And where does that surplus go to? It's either a difference between T minus G. Sorry, T is greater than G. In other words, there's government savings, or S is greater than R. Private savings are greater. Okay, there we go. I'm not going to spend too much more time there. Okay, let's just talk very briefly about a floating exchange rate regime. The main adjustment is a rapid change in the exchange rate. Okay, as prices move about. Okay, capital flows, potential and actual, are the key determinant of exchange rate movements in the short to a medium term. Okay, but that's talking about a floating rate exchange. Okay, the impact of the exchange rate on trade and capital flows, we're going to focus on two different models or two different perspectives. The elasticities approach, okay, which looks at the effect of changing the relative price, okay, of both domestic and foreign goods, okay, and the absorption approach, okay, which looks at aggregate expenditure and savings decisions. So just from two different points of view. We talk about the elasticities approach, okay, the effect of devaluation, okay, and you see the words we use very specifically: devaluation in a fixed system, or depreciation in a floating rate system of the currency. For reducing a trade deficit will depend on generally on demand and supply curves for these various goods and service. Okay, devaluations will improve the trade balance. It's called the Marshall-Lerner condition. Okay, what is the Marshall-Lerner condition? Wow, look over here. Okay, I was going to call it, it's not a W, we know that, of course, WX and WM. Okay, remember X and M is exports and imports. The shares of exports and imports in total trade. Okay, EX and EM, against on an E, of course, we know that. Okay, is the price elasticities of foreign demand for domestic country exports and domestic country demand for imports. In other words, how elastic is the demand? What do we note? Okay, that the shares of exports and imports, okay, equals 1. And an initial trade deficit would mean that what M is greater than X. We've seen this many times before. Imports is greater than exports. Okay, and if that takes place, there will be a depreciation of the currency Y. Yes, the trade balance will move towards a surplus, but the currency will depreciate, and they're all interconnected. Okay, and why is that? Remember, of course, guys, that if there is more imports coming into your country, well, then how do people, what do they create? That's a trade surplus. That's fantastic. But the problem is that if all American people perhaps want to buy South African goods, okay, then we would have what we would call a trade surplus. Okay, sorry, I'm going the other way around. My apologies. Let's talk about when there's imports. Okay, when there's imports and I'm bringing goods in, okay, remember we've got to pay for those goods. Okay, remember the minute you need to pay for your goods, what happens with that? Okay, as you pay for goods, you pay whatever your currency is. Okay, so you're buying another currency and you're selling yours, and as you sell down, that obviously depreciates then your currency. Marshall-Lerner describes combinations of export and import demand elasticities, such as depreciation of the currency, surplus, appreciation is a deficit. Okay. How does this relate to elasticities? Marshall-Lerner says that the demand for imports and exports, okay, must be sufficiently price sensitive. There's the elasticity concept, that an increase in the price of imports increases the difference between export receipts and import expenditures. How do we move towards the trade balance, Okay, let's talk about a surplus. A change in the rate must decrease domestic expenditure relative to income, and of course the other side will be as well. Okay, same side, it must increase domestic saving relative to domestic investment. Okay, because if there is excess capacity in the economy, currency depreciation will increase output or income by switching demand then towards what? Domestically produced goods and services. Okay, why? If there's additional income, some of that income will be saved, income rises relative to expenditure, and the trade balance will improve. If the economy, I know this is a little bit technical, guys, I'm going to move through it. If the economy is at full employment, currency depreciation will reduce domestic expenditure and then, yes, improve the trade balance. The main mechanism is what we call a wealth effect. A weaker currency reduces the purchasing power of the domestic currency denominated assets, and households, what do? They reduce their expenditure because it's worth less to spend, and they increase their savings. Okay, so after all of that, the generalized Marshall-Lerner condition says that the more elastic demand, doesn't matter for inputs or exports, very likely that the trade balance will improve. Okay, over our page. Top of page 19. The elasticity of demand is then dependent on 4 factors: the existence or absence of close substitutes, the structure of the market for that particular product, its share of people's budgets, and the nature of the product and its role in the economy. Okay. Price changes have got 2 impacts on demand: the substitution effect, and this is just general economics, guys, not so much specifically related to Forex. Substitution is, can you substitute the product? In other words, if the product becomes too expensive, can you substitute it for a similar product? The income effect is the fact that price changes, yes, they do have an impact then on real purchasing power. As the price of a good, let's first talk about rises. As the price of a good rises, people's purchasing power, you've got less money available, okay, and vice versa. Okay, and yeah, the strength of this particular effect, called the income effect, will depend on each person's budget, and the more important the product, the stronger the income effect will be. Okay, I'm not going to spend too much more time over there, but if you do take a look then at the J-curve and the Marshall-Lerner condition, let's just chat about this. Okay, we're having a look at factors that determine price elasticities, and we see that exchange rates will be more effective in terms of trade balance adjustments if a country imports and exports the following. What type of goods? Goods which there are good substitutes, they trade in competitive markets, okay, and luxury goods rather than necessities, goods that represent a large portion of consumer expenditures or a large portion of input costs for final consumers. Okay, even when the Marshall-Lerner condition is satisfied, we can still have a devaluation or depreciation of a currency. Okay, and sometimes what happens is it gets worse before it gets any better, and that's called the J effect. It goes down a little bit first, gets worse, but yes, as per the Marshall-Lerner, we do expect it to go up, and there it kicks in. Okay, but it does take a little bit of time over there. Over our page, I'm just going to mention over here, just the very last approach, we talk about the absorption approach. Okay, and what's the difference in absorption and the elasticities approach? The elasticities approach looks at the expenditure switching effect, okay, of changing the prices of imports and exports. What do you do when the prices change? Well, you move here, you move there, you change your purchasing, etc., etc. Okay, the absorption approach, okay, really doesn't work much on that approach, but looks at what we call a macro view of the relationship. Okay, what did we say previously? Okay, the trade balance is equal to the country saving, including government fiscal balance, less investment in new plants and equipment. Okay, and the trade balance essentially is equal to the difference between income and expenditure. We're going to call expenditure what, guys? The absorption. Okay, in order to move the trade balance towards more of a surplus, okay, how do you get a surplus? Depreciation of the domestic currency. And what would that then do? It'll increase income relative to expenditure, increase national savings, or increase national savings relative to investment in physical capital. The absorption approach tells us that currency depreciation won't improve the trade balance, okay, unless, of course, it has a corresponding change then in the capital account. In other words, not only do domestic savings need to increase, but that saving must be channeled then. You can't just save. It's got to be channeled into the capital account. In other words, buying financial assets then from foreigners. Everything being equal, foreign and domestic asset prices must change to the extent that foreign assets become more attractive and domestic assets less attractive to both foreigners and domestic investors. Okay, a little bit theoretical there towards the end. Don't focus too much on the grand detail of everything over there. Just get the concepts behind those two approaches that we spoke about, elasticities and absorption. And as you can see over here, guys, that brings us to a conclusion of learning module 7. Currency exchange rates we've got over here on page 21, a little bit of a summary there for you. Continues on then on to page 22. As per usual, when we are done with a particular reading, we always encourage candidates to go back to the beginning of the learning module just to take a look then at the learning outcomes for the particular module. Read through those again, just make sure you are familiar with those and understand them. Then you have most likely gained what you need to from the particular learning module. If not, perhaps might be worthwhile. And currency exchange rates is not an easy one. It might require one or two separate watchings, readings of the notes. This then brings us to a conclusion of the pre-readings then for economics. 7 learning modules all in all.